The 10-year Treasury, as we have seen here, it defines a lot of our mortgage rates, sort of analysis, predictions. It defines a lot of our credit card, student loans, auto loans, rates, predictions as well. And the 10-year can also define some trends in real estate transactions and investments. So we're going to talk about how cap rates, so capitalization rates in real estate and the 10-year Treasury have sort of show a warning to the real estate panorama. We're going to focus today on single family homes because real estate is so vast, so hard to analyze based on the different types of properties, industrial, retail, multifamily. So we're going to talk about single family cap rates. The US 10-year Treasury note closed at 4%, or 4.08% on Friday. So that's the yield. And you can see I did some research from CRB. The multifamily cap rate is around, at least for example, in Charlotte, 5.5, Houston, Nashville. So this is in the South. The average is close to 5%. In some places a little higher. I couldn't find really single family homes because most investors go after the multifamily. However, this paints a good picture. We are seeing only a 1% spread between the 10-year and the multifamily infill, at least in the South, which is considered a growing market. So let's talk about the spread. So the spread is the difference between the 10-year and the capitalization rate. The capitalization rate is defined as your rate where you're making money. Basically, if your rent is $1,000, so a year that will be $2,000, $12,000, and then you pay for that property $100,000. You're basically making gross 12%, and then you have to subtract maintenance, taxes, insurance, and so forth. So say those 12,000 becomes 8,000. So 8,000 divided by 100,000, that will be around 8%. Now there's different metrics. There is cash on cash return, there is net, there's leverage, but let's just focus on the cap rate, which is what we are investigating here. So the lower the spread, so the lower the difference between the 10-year or even a certificate of deposit and what an investment property provides, the lower the probability that you're going to go to real estate. Because why would I go into a real estate to make only 1.5% more in yield when I have to deal with vacancy, when I have to deal with repairs, when I have to deal with taxes, when I have to deal with insurance, when I have to deal with natural disasters, so I have to deal with managing tenants, so there's that difference. It's a no-brainer. If the spread is lower, I'll just go and buy a bond because I get a guaranteed return without the headache. So this is from Nick Gurley's account in Reventure CEO, which is a good page for analytics. It looks at real estate data. You can see the 10-year Treasury in orange just climbing up since 2021 as the Fed cycle of rates increased, right, from almost 0.5% to when it peaked at 5% in late 2023. Currently is around also 4%. And you can see the cap rate very stable at 5%, but it has been going down because prices of houses have gone up. So now the spread is almost only 1%. Now this cap rate is based on their model, so we are not sure, but we'll think around the cap rate is around 5.5%. So it's a good analysis. So let's just do the spread. So based on his analysis, Nick's analysis, we can do that the risk-adjusted returns picture is not favorable for real estate investors. Why? Like in the current period, the spread is around 0.9, so let's say 1%. In 2011, 2012, it was 2.9. And at the peak of the pandemic, when people were just buying and buying and buying, no inspections, no liens, no covenants, absolutely just buying properties because rates were low and prices were not as high. So you are getting almost a 4% spread. So your cap rates really justify buying real estate. Now, let's focus on that 2022 because that might be also the reason why cap rates are so low. So if you can see here in our analysis, this is from Redfin, the National Investor Purchases. When we mention investor, we are not talking about families or individuals that are buying their first house. We're buying companies that are trying to make a profit on real estate rentals, especially in the single family house. And you can see it just plummet in the first quarter of 2024. It just plummeted from the peak in 2022, which kind of justifies that spread. You can see, as in the previous slides, we saw the spread at 4%. Now the spread is almost 1%. Of course, you're going to see less investor purchases. But it's cyclical. The markets are cyclical. It's wherever there is more risk-adjusted returns, that's where the money will come. So the thing to fix this issue, if you want to see investors coming back, the 10-year has to go down, which is unlikely because we saw that the Fed cut rates by 50 bips and the market price yields by around 50 bips higher. So that's unlikely. I don't think we're going to see lower rates. The other factor will be that cap rates have to go up, at least 6%. So the spread becomes 2.5. Now, to do that, rents will have to go up. They're currently going up at 2-3% annually. In some places, they're actually negative because the supply of new properties, of rents, of new properties have actually made rent be stable. So all the money that came in 2022 and all the new construction that started to materialize and actually is making supply increase, which makes rent basically flat, which actually is one of the reasons why we won't see cap rates go up, because your rent, which is kind of your revenue indicator, won't go up. And the other factor is for prices to go down of houses, which is the thesis and the theory that we're kind of defending, because even in 2022, when people were just bidding and buying, they raised their prices so much, maybe past the actual rational and equilibrium point. So people maybe start realizing now that $600,000 that they pay for that $400,000 house might not be the best idea. So we actually might not have seen a really rational time in 2022. Actually, many investors or many people actually overpaid, and that's why your cap rates are actually not as high. So what do investors have to do? Investors have to do for, I think, in this scenario, for fixed costs that are low, that will increase your cap rate, right? Because we can see insurance and property taxes rates, they have to come down, or they have to be minimum to make sure it doesn't eat too much of your revenue. And you also have to be going into places across the states, cities or towns where the population is growing at least 5% more a year, because there will be a sign of influx of people and people need a place to live. So that will probably increase the market. But you need that low insurance and property taxes to keep your costs down. Now, there's another possibility. Do we envision a scenario where the 10-year drops substantially? Maybe that could happen, but the spread with MBS securities widens, effectively keeping mortgage rates where they are now, or even prices. So I think, and I can even argue that even if the 10-year drops substantially and prices still don't go down, we're still not going to see a good spread between real estate and the 10-year. So for now, for example, I was checking the other day, which actually is last week. Wells Fargo has 4.75 certificate of deposit. I think I said the 5 or the 10-year. No brainer. Why would I buy an investment property when I get a guarantee 4.75%? It just saves you the headache and all the maintenance you have to do in real estate. So let us know what you think, and welcome to Mirror Finance for those of you who haven't seen it. Thank you.